Hi, and welcome to our on-point webinar, Uncover M&A Possibilities, Bridge Loans and Deal Creativity. I am Bridget Height, host and moderator for Oak Street Funding webinars and podcasts. And today I am joined by Adam Farag, VP of Strategic Markets at Oak Street Funding. And we are welcoming back Rob Madore, Vice President of MarshBerry, to discuss using non-traditional deals to grow your business through all stages of M&A activity. So Adam and Rob, thank you so much for joining me.
Good to be back.
Great to be here.
Well, I'll just launch right in. To start, can you talk a little bit about the current market trends and valuations? Rob, I will start with you. What are you guys seeing at MarshBerry?
Sure. We're seeing a lot. But what we have found recently across Q1 is a resurgence right, in total deal volume. So if you look at our numbers, which we're finalizing from first quarter of this year, it looks like it actually could tie the all-time record for Q1.
Oh, wow.
So deal activity has been up, as has the total assets being acquired. So, deal activity is very strong, and we would anticipate that should continue across the year, especially when considering things like tax changes, which I'm sure we could probably talk about a little bit. When it comes to valuations, I think over the last 5 years, there's been a pretty continuous increase in the external, the strategic market values for these businesses. I would say that's plateaued. I wouldn't say peaked.
Okay.
Right? Because I think peak kind of indicates that it's
So the voice coming, yes.
Yeah. Right. But this is, I would say, more plateaued, where, the best businesses are still receiving those extremely high multiples. But buyers are maybe being a little more selective on the strategic side and looking for certain things, some of which we'll probably get into today, but really a good team, some growth. I probably used the same term the last time we were here, but it's no longer if you can fog a mirror, you get a super high multiple. Now they're actually digging a little bit, they being the broader buyer universe is digging a little bit more into where the fit is.
Okay, great. Do you have anything to add to that?
Yeah. And so on the lending side, I think everybody talked last year about how much rates had gone up, right?
Mm-hmm.
I think the market is truly adjusted to the rates going up and kind of staying where they're at. I think the 1 month's at like 5.5 on the treasury side, 5 years at 4.5. So, that's a big change from 2 years ago. And I think some of that, drop in the deals that we saw in 2023 a little bit had to do more so with adjusting to that rate increase. But we've seen that kind of level out. Deals have come back, to Rob's point. And I think there's a lot of things happening in the space. And it's really become a lot about structure of those deals. I think the folks that are going to sell, they still need to sell, right? They're going to retire, they're going to move on. And so somebody has to buy that, whether it's an aggregator, strategic, peer-to-peer sale. And so they've structured the right deals to get the deals.
I think the other thing is the why. Why are deals happening? And it's a couple reasons. One is obviously exits. Advisors are aging and they need to find I'll call it a succession plan for their book of business. But the other thing is the value of scale, I think, is becoming more evident across our space. If you look back 5 or 7 years ago, if you said you were $1 billion RIA, it was like, wow, that's incredible. Right. And now, the new billion is 3 or 5 billion, right? And I think it's a combination. I mean, we heard for years that fees were going to compress, and that was going to be the value of scale. I think it may be addition of services and ability to bring in, talent, right? So the human capital component of scale. So I think the fact that scale is necessary to get over some of these common growth walls for businesses is continuing to drive deal volume and a need for certain groups to actually sell outside of just, hey, I want to go and, be on my yacht for the next few years.
Okay. So starting to get into the topic of this webinar, how do you start preparing your business for sale? And what are the first steps?
I think this is your way.
So I'll start with the ideal world. The ideal world is you're preparing your business for sale from the day you start it, and you have that intention, all the way through where, it's not necessarily looking at it and saying, what do I have to do to sell this business someday? There's always going to be a buyer. It's more of saying, if I want to create optionality, so at any point across the lifetime of my firm, I can choose what I want to do with it. And that may mean selling the business externally in 20 years. That may be taking out private equity capital in 15 years. That may be, leveraging debt, to bring others within their firm into equity positions or to buy a business. So I think it all starts at the beginning with, one, what is it you're trying to build? Are you trying to build for enterprise value or cash flow? I think they're kind of tied, but you can make an argument that you build a different business if you're trying to create enterprise value versus a nice distribution at the end of every year. And then the other is, I think that's really it, actually. It's really, what are you trying to build? Okay. I'll let you go now.
Yeah, no, on top of, what are you trying to build? I think also, what type of seller are you going to be? Where it says, like, who am I going to be? I'm always chasing who I'm going to be, right? Well, what type of seller are you going to be? There's folks that want to sell and retire immediately. There's folks that want to sell and join something bigger. Right. There's deal structures and deal valuations for all of these scenarios. And what we're learning as the market evolves is they're very different, right? Those deal structures, it's wide, right? The valuations are wide, the structures are wide. You can get very little money up front and have a very long runway of rolled equity or earn out or something like that. You can get most of your money up front and very little equity. And, I think that all starts with just kind of taking a look in the mirror and saying, who do I want to be as a seller? And so then I can go look for those types of deals. You don't have to know all the answers. I think Rob helps with that.
I think that's exactly it. I'm looking in the mirror. That truly is. If you can't look 20 years in the future and say, hey, what do I want to build? Which most can, unless they built sold business. But looking in the mirror, it's, do I have my financials in order, right? Am I managing the business like a business? That's always a great place to start. The other is understanding the strengths and weaknesses of your unique business. And typically that comes down to two things. It's human capital, right? Like, what does your team look like? And are you building a team that's beyond just you, right? That buyers evaluate from a position of risk management, and the deal structures follow that, and the prices follow that. So can you remove concentration risk from your own firm? Advisor ages, production. Is production coming from one individual, or is it coming from, a team of individuals? And then apply that same logic to your client base. So what are the ages of our clients? What's our average size client? Or do we have a lot of 70 and 80-year-old clients that are, over the next, call it 10 to 15 years, chances are they're going to be turning over in some way, shape, or form. Do we have a lot of 40 and early 50-year-old clients? And then is there concentration risk as far as, your top 2 or 5 clients carry 10% of your revenue? So, that it's always good to start looking in the mirror and saying, like, where are we strong? Where are we weak? What's driving value for us? What's something that may be taken away from you today or over the next 3 to 5 years?
Yeah. And do I have a book or do I have a business? Right. Do I have a list of clients where I'm kind of an owner operator and I'm selling this list of clients really to, another firm that's going to bolt it on to whatever they're doing? Or, do I actually have a business that has a continuity plan that has, individuals that are working that are needed to make that thing go? I think that's another thing you have to take into consideration as well.
Okay. Great answers.
Very different thing.
So before a sale, sellers want to be at their most profitable and attractive, obviously. So what are some key aspects a seller should focus on to make their businesses more attractive to buyers?
So at the end of the day, I think consistency with this stuff is key. Okay. And a lot of my answers on the sell side stuff are going to be related to how we would look at extending credit to a buyer, right? Because I think the buyers are evaluating those same things. When we're looking at extending credit to somebody to buy a business like this, one thing that we want to see is consistency in your financials, right? I want to see historical, proven track record that you can operate this thing and there's not a ton of ups and downs. The last thing you want to see is it was one way and after the sale, it's going to be a completely different way. And you just kind of have to hope that happens. So I think consistency is key when you're looking at what to look at before the sale. That's kind of my biggest thing.
That makes sense.
So let me start off with something that's unexpected because I'm the investment banker on the call on this webinar. So I suppose people expect me to be like Gordon Gekko and say, well, this is what you do. The first thing you do is you stop using the double ply toilet paper. You go down to the single because it saves you 35 cents a unit. Like, that's not it. I think the first thing is it's a misconception that if you're thinking about exiting, transitioning, selling your business, that you should change how you work. One of the first things we say to folks is, look, you want to continue running the business the way it's been successful, right? You don't want to change things. You don't want to say, well, I was looking to hire a new, client service advisor, and I think I'll just hold off on it. Well, that may actually strain the business and make it less attractive and create some more risk. So it's one is just continue to run in a way that's made it successful. As far as leverage, so we focus a lot on leverage when we're representing our clients, obviously, and understanding the timing is a big component of leverage, right? I said optionality earlier. This ties right into that, which is you have to know you're selling to an external partner. So, some of the large organizations, the Mercers, the Cap Trusts, right? The Cerities, really great organizations. You need to have a 4-year horizon, right? This isn't a wake up and tomorrow I say, I think tomorrow I want to be out of this business. I'm going to sell my business. That's a pure exit. We can talk about that. The majority of the work that we see is strategic, right? They're looking for growth. They're looking for a partner to help them grow, or they're looking for a kind of more of a long-term succession plan as opposed to a short-term. And so you need 4 years. You need to be there for at least 3 years post-deal with, because typically there's an earn out in these deals, and that it typically takes between 6 and 9 months of the process. So you really need to think about 4 years. If you're doing it internally, which we could talk about that, whether on this one or another, you really need to think like 10 years ahead, because you have to transition both management responsibilities. You have to create an organization that's comfortable with taking on risk, right? Whether you were long or whatever, and then you actually do transition out. So that's really a 10-year thing. To make your business most attractive, it doesn't matter if it's if you're thinking about selling in 10 years or you're thinking about selling 2 years. You need to think about scale, right? Size and scale is always going to be impactful, right? And that's size of assets, size of revenue. The second is profitability, right? Are you managing the business profitably? Are you managing like a real business? I'm sure Adam would agree. If you came in and looked at business on the lending side and you said, wow, this is like their financials are pristine. They're running this like it's a business, not a personal piggy bank, which that's right. Yeah, no judgment on anyone. So there was some great businesses that are like that. So are you managing like a business? The third is growth, right? You always want to be growing. That's one of the things that, to your first question, what are the trends we're seeing around valuations? Business growth is becoming a little more of a non-negotiable. They don't just want flat businesses. So they want to start seeing true organic growth. And then the last is human capital, right? Okay. You want to, and that probably goes to a place that you wouldn't expect, which is ownership. Right? A business that has more diversified ownership can actually be more attractive as an acquisition target. It shows that there's less risk within an organization because it's not wholly reliant on one person. And it also allows it allows a buyer to create alignment with more than just the principal owner.
Yeah, I mean, so it's client retention too, right? Okay. You've got a business that's running like a well-oiled machine. With the growth and everything else, I think you have to look at client retention. So last year, the market was fantastic. So if you're not growing organically, there's a problem, right? And people are going to sniff that out and say, are we churning clients here? Like, what does that look like, right? So it's part of it.
I like my stories, and like the story I often have in it. Obviously, we do a lot of work with consulting, but we do probably just as much, if not more, on the M&A side. The story I often hear from owners is, well, right now is not the time to sell my business. I want to sell in 3 years. And then over those 3 years, just double. And then I'll sell.
Right.
And when you start peeling back the onion or, pull back the sheets, you're like, well, you've really been growing about 6% a year. And if you look at some of like the indexes, it turns out you're actually underperforming the market. So, and that's what I think what's been laid bare over the past 2 years of acquisition. As these buyers become more mature, they say, well, we're building a growth machine here. You can be a part of that machine, but we need to see, especially in a higher interest rate environment, it's no longer free cash. We need to see that you can grow on your own, not just inorganically by kind of plodding things on. So,
and how many of the guys that you talk to because when you said that, it just hit a nerve. I'm going to sell in 3 years, right? We hear that all the time. Well, I'm going to sell, and then you talk to them next year. Well, I'm going to sell in 3 years. Talk to them next year. I'm going to sell in 3 years, right? And it's like they're waiting for this event, or like this thing to go off to be like, okay, now let's actually dig into that timeline. And I think that hinders preparing your business for sale, right? Because I don't know that you're doing the right things, because it's always like this, I can make it happen in 3 years whenever I want to start, right? And not taking those steps and not truly being honest with yourself there, I think hurts business.
I just see it as look, you'll always be able to, most businesses will be able to find a great buyer for them, especially if they have some of the things we talked about. Being prepared allows you to choose where you go, to find better fits, to have more suitors, to get a better deal, to have different structures. So, sometimes it's more around the edges, but it ends up making it a smoother transition and ultimately a higher value.
All right. So the title of the webinar is, it talks about bridge loans. So for business owners out there who might not know about this option, can you provide an overview of what a bridge loan is specifically in the form of dividend recaps for sellers?
Yeah, so absolutely. A few months ago, Rob and I met, and we talked about this massive sector of the market that's going to be selling in the next 3 to 5 years.
Okay.
And maybe they don't need a 10-year loan. Maybe they need a 3-year loan, right? But then who wants to do a 3-year loan that has a 3-year payback period that destroys cash flow, right? So we're kind of running into a few of these scenarios. And so what can we do to fix that? And so we kind of came up with this idea of a bridge loan where if you've got to clean up some debt on your balance sheet, if you've got seller notes out there, if you got to pay somebody off, if you need a little bit of a liquidity event before you do the sale in 3 years or 5 years, let's put a loan product together that's only 3 or 4 years long, but has an amortization payback period of 10 and just has a balloon.
Okay.
So it's not going to destroy your cash flow. You're going to be able to dip into your cash flow a little bit, pay back that debt. You're going to get an interest rate or an interest write-off on your taxes, right? And you're going to get the liquidity to either go do what you need to personally or pay off debt that you have that's outstanding on the business.
Right.
And overall clean up the balance sheet, because that's kind of like I talked about before. I think when we're looking at financials, you want to see clean, consistent financials, especially when you're preparing for sale. So if somebody's got 7 seller notes out there and one of them's 2 years long and one of them's 10 years long, and somebody's not at the company anymore, it's like, let's clean all this stuff up a little bit so we can really go through a good process with Rob here. And I think that's a part of it. So we've seen an increased demand for that type of debt, and are starting to provide it.
Okay.
Yeah. And I'd say, a large part of what our team does, not just me, but, a lot of the others on my team, MarshBerry, is it's about providing different avenues to achieve what business owners want to do. It's not really, we talked a lot about selling businesses. I spent a fair amount already on this webinar, but it's not the only thing we work on. A lot of it's for owners that may never want to sell a business, or, they're just trying to be more intentional. And the scenario that often comes up is, if you're a wealth manager, you're probably pretty used to dealing with business owners that have built, nice businesses, and they have paid a lot of paper wealth that doesn't necessarily match up with their own personal balance sheet. And, the commentary we often get is, well, I don't want to sell my business for 10 years, 15 years, ever. It's more about them saying, look, I built something really impactful, a really valuable business. I would like to kind of create a little bit of liquidity off of that in the short term. For some, it's just about cleaning up and preparing for a larger ultimate event. For others, it's, I've got great cash flow. Even if I do something like this, I can take a little bit more home. Business is covering it. I still have the capital to continue to grow the business and then ultimately reach maybe for something higher, a higher valuation, something down the road. And then it's going to ease a little bit of my own mental burden.
Yes.
Because I see I've got this really large business. I want to make sure I can it's not really a true de-risk, but often in people's minds, it's a little bit of a de-risk.
Right.
Where they see a little bit more of that cash.
Well, and I think you see a lot of these owners that have a very significant portion of their net worth tied up in this business. right? 75, 80% sometimes or more.
And climbing, given the valuation.
Exactly. So, these guys and gals are making decisions to go, maybe do things on the personal side that they might have to wait 3 or 4 years to do. That maybe we can bridge the gap to that. And that's kind of the idea with these types of loans.
Great. All right. So is a dividend recap bridge loan suitable for all companies considering a sale, or are there specific financial health indicators that make a company a good candidate for this approach?
Yeah. So I'll take that on the lending side. I think, is everybody the right fit for a debt product? The answer to that's right. I think we can all.
That makes sense.
Right. There's all different types of businesses that have different cash flow and everything else. And we are, and most lenders in this space are cash flow lenders, right? We're going to see what's your revenue? What are your expenses? What do you have left over? What do you need to live on personally? What can I view as cash flow that can pay our debt back? And then I'm typically going to lend you a multiple of that, right? So, I kind of put a little example together for this to talk about. If you have a company that's got $10 million in revenue, and you have $3.5 million of cash flow, right? So you're probably going to sell that business for about $30 million. I'm just using round numbers. It can be higher, it can be lower, but let's just say 10 times EBITDA, 3 times gross, right? You're gonna sell that business for $30 million. You have 3.5 of cash flow, so we would lend up to 4 times in senior debt that 3.5 number, right? But that's high leverage. I don't think a bridge loan is good to be a very high leverage instrument. Okay. If that makes sense. Then you have like 2.5 to 3.5, and that's like our sweet spot for senior debt. 2.5 to 3.5 times that cash flow number is like our sweet spot. Right at that 2 to 2.5 number, I think that's your dividend recap loan. That's your bridge loan. Get some cash out. That's your cash out. And, that doesn't even have to be a bridge loan. Like a bridge loan can go higher than that if we're paying something else off. But for taking cash out personally, I think that 2 to 2.5 times number. So for this business, if it's going to sell for $30 million, you take $7-8 million, right? And a deal that you're probably going to do with one of the big, teams out there is going to be 20-25 million up front, and the other 10 or however much in a long-term earnout or 4 to 5 year, performance bonus or something like that. So if you could tap in 7 or 8 million out of that 20,
right?
I mean, that's significant, right? It's not just $1 million. And then in addition to that, if you're paying a loan for $7 million right now on a 10-year, deal, that's going to cost you about $1 million a year in debt service. So you're really only eating 29% of your cash flow towards that debt service.
For me, if I was advising business, what I would say is this makes sense if you can maintain your growth.
Okay.
Yep. And if you have to leave enough in the business, right? Adam was talking about kind of leverage ratios, right? How much debt you want to take on. Well, you obviously don't want to bleed your cash flow dry where you're no longer able to reinvest in the business and continue to grow it. That would be a short-term solution that ends up cannibalizing a long-term opportunity. So it's, for me, I think Adam kind of covered it pretty well and has better perspective on that. From their side, from my perspective, it's just make sure that you have the cash flow to continue growing business, investing in people, investing in technologies. You're not going to get to your long-term goal without considering both of those things.
So that probably leads in nicely to my next question, which is what are the pros and the cons of this benefit?
So pro side, I think we've talked quite a bit about, the pros here. I think, you get some liquidity, you clean up your balance sheet, you get some peace of mind before sale while you're exploring who you want to be and where you're going. So there's a number of pros out there that I think this specific product is good for. So cons, definitely cons, right? But if you've got 7 shareholders that all have different percentages, let's say it's a mix of Gen 1, Gen 2, and, they know they're going to sell ultimately and are looking around, and you've got one individual or shareholder that wants to do this for their own personal reasons, that can get a little complex, right? Because the debt service is going to have to come directly out of their distributions and not to affect the others.
Right.
What their distribution would have been without debt. And then what are the tax implications of that? Which, there's other things to consider there. So, I think, it could be complex, but it's only going to be as complex as you make it.
Okay.
I mean, at the end of the day, everybody has CPAs, everybody has consultants that can help you these things.
So Adam, as a lender, can you speak on what kinds of structures you are seeing from these bridge loans?
Yeah, absolutely. So we have a couple going on right now,
Okay.
a handful of deals. One in particular that we're doing that I think is going to be kind of the box that we look at these in. It's going to be a 3-year deal on a 10-year amortization schedule, and is a kind of sub 30% loan to value. I think it's a good number. So, you get the benefit of the long-term deal on a short-term deal. That's your bridge, right?
Mm-hmm.
So this is a tailored solution for your individual situation.
You want to just to make sure everyone that's watching is aware loan to value.
Yes, LTV. So 30 LTV. You see acronyms here. One of the things that we're going to evaluate as a lender all the time, that's going to be a foundational thing that we look at, is a loan to value.
Okay.
Now, when you look at 4 times EBITDA high leverage stuff, 60% loan to value is kind of getting up there for us. I think sub 30 is kind of our number for something like this. If it's going to be used for owners to take out liquidity and be a true dividend recap.
Okay.
Now, if it's paying off other debt and thinking about it, we can elaborate up a little bit and maybe change the structure around a little bit. But for the idea of what we're talking about here, I think sub 30 is good.
Okay, great. So what are some of the other types of sellers, and why is it important to know what type of seller you are?
Yeah, I think I'll start that.
All right.
That all goes to timing as to what, you have to think about your exit and what you want. And that could be, I think we talked about the sell and stay, which is more strategic. Like, what are you looking for? Let me put it actually slightly different. Instead of trying to say, what are the types of sellers? More of this, what are the problems that are trying to be solved for?
Okay.
One is just, is a delta between the external valuations in the market, which have continued to rise, and the ability for internal successors, Gen 2, Gen 3 advisors to actually purchase the business away from that, 1 or 2 or 3 principal owners. That's a solution that's being solved for oftentimes effective. The other is going to be, a growth, right? We talked about the walls, business complexity, capacity walls as the business grows. And it's typically $500 million, plus probably 100 million, 250 million, 500 million, $1 billion, 3 billion, 5 billion. It's all the places where you need to take a step back and think, okay, this is how I got here. What's going to get me over this hump into the next thing? It's not going to be operating the same way. Oftentimes, those are the challenges that are being solved in external. In both of those scenarios, you're looking for a strategic partner, not a true exit.
Okay.
And so that's when timing really comes into play. It's really important to think about that. Like I said, if you're doing it internally 10 years, if you're doing it externally 4 years. So that's really important. If you're, if you have a nice business or book of business and you're just saying, look, I want to find someone that's really just to take on these clients in a way that I like serving them, realize some value for the business I built over years. You still have plenty of options. You just also have to go in knowing you may be able to exit sooner. You're going to have probably a more limited selection of different partners or buyers, and you're going to receive a significantly lower multiple. You're not getting the deal terms are going to be way less favorable, and the multiple is going to be much lower.
Yeah. I mean, that's been a topic of discussion for a number of years now, is this internal succession versus external opportunity. And I think to Rob's point, you kind of have to know what you're getting into. We talked to a number of people being a lender of, hey, how can we lend to G2 because they're going to take over? And I think the earlier that you're getting involved in that type of deal, the better. As Rob said, there's going to be a significant discount because cash flow can only pay for so much. And typically, these Gen 2 advisors are not just going to write a check for the equity.
Well, that's a good point. So probably a whole other webinar, which is even if your internals are willing to take on the risk and finance it, typically the business still has to be the backstop.
Right.
And the cash flow can only finance so much.
That's right.
It can only take on so much leverage.
It's math.
But that's a whole other. I think another thing that's representative of kind of the scenarios that we were both talking about is the structuring of the deal. And if it's a strategic sale where you're saying, I'm looking for a growth partner or someone to bring in my people, someone to add additional services, take us to the next level. Typically the deal structures are, significant portion, 75, 80% of the capital up front. My multiples, a 3-year or 4-year amount, right? Sometimes a retention payment after year 1. So they're structured to create alignment with the sellers over a longer period of time because they want to see you stay and continue to grow.
Right.
If it's a transition or an exit, oftentimes what you see is a seller finance deal. So almost like loan, like the cash flow of the business is kind of paying,
right?
You're paying for the business. You're kind of paying for someone else to take the business over time. But you are having a little bit of liquidity on that. And then oftentimes there's going to be some measure of either holdbacks or clawbacks that's going to be based on how many of your clients stay with it. So if you're selling a book of business, they're going to say, well, we'll pay you on what comes over and stays with us for years. And that could be over 3 years, 5 years, 7 years. You don't, because you're dealing probably more peer to peer at that point, you have a lot less flexibility. The structure looks like, so it's more friendly to the buyer, I would say.
Well, this was lovely. Thank you both for being here and joining and delving into this all.
Unfortunately, I really like what I do.
It shows. It's a good thing.
Anytime.
And thank you to those watching and listening. And don't forget to tune in to our On Point podcast episode where we discuss these topics further. So available now on your website, on our website, and wherever you listen to podcasts. See you next time.